So let's say you are thinking about personal finance and a long-term investment, or you want to prepare for retirement, and you know you need to get your money to work for you, even when you are asleep. You may have heard of a rule of thumb, the so-called rule of 72. It's super basic, but also super helpful when you think about long-term investment. The rule of 72 says if you divide 72 by the average annualized percentage return, that's approximately how many years it takes to double your money that you put in at the inception. What it does require is that you need to reinvest the returns every year so that you get the compounded returns. For example, if your long-term investment returns 4% on average a year, and every year you reinvest that 4% for compounding so that money grows like a snowball. It takes about 72 divided by 4, that's 18 years to double your money. And if it's 5% a year, it takes about 14.4 years. If it's 8% a year, it takes about 9 years. If it's 10%, it takes about 7.2 years. And if it's 16%, it takes about 4.5 years. So if you put 100 grand into your investment, which you expect to return 16% a year, in 4.5 years, you will have 200 grand. Does that make sense? Obviously, it's a linear approximation, but we can see how good this approximation is. Let's calculate the final returns with the compounding rate of return. For 4%, 1 plus 4% compounded for 18 years is 2.026, so it's pretty close to 2. For 5% compounded for 14.4 years is 2.019. For 8% it's 1.999. For 10% compounded to 7.2 years is 1.986. And for 16% compounded for 4.5 years is 1.875. So you see, for 8% annualized return, after 9 years, $1 will grow to $1.999. So the rule of 72 is quite accurate. For other rate of return, smaller or larger than 8%, the approximation is less accurate, but still works pretty well. Is there any investment that guarantees, for example, 8% annualized return, so that you can double your money in 9 years? Well, no one can guarantee anything. However, for long-term investment, the US equity index, for example SPX, which bets on the economy of the United States of America, returns roughly 8% over the last many decades. Some periods higher, some periods lower, of course. While high-yield bond index, you can use HYG and JNK ETF as an example, returns roughly 4 to 5% in the long run. Again, some periods higher and some periods lower. If you periodically put money in, for example, into your 401k or IRA, you likely will reap the fruits when you need the money further in the future. I say likely because, again, no one can guarantee anything when it comes to investment or trading. You could have a long period of bear market that may last 10 years, just like the first decade of 2000. So remember to consult a professional if you want to have a better idea what works for you. Some of you may have a higher risk appetite and put all your money into some risky asset, say options. In that case, you could double your money within a week or sometimes a day. But you may lose all your money too. How to allocate risk is a topic for another day. Okay, hope this is helpful. Thanks for watching and hope to see you next time.